Hello, Barry. Thank you so much for taking the time. I was wondering if you could start off with a quick introduction.
Sure. Um, I am Barry Eggers. I've been doing venture capital for about 28 years now. Started in January 1997, so that math works. And in uh, Started off in a firm called Weisbeck and Greer Venture Partners. And in 2005, broke off from that firm to start Lightspeed with three um, co-founders. And we started Lightspeed in 2005 and been involved with building that and running it and with my co-founders and hiring people and setting strategy and doing all sorts of stuff. And we've sort of grown in parallel with the VC market over the last 20 years to where we are today. And I'm been winding down for the last couple of years, so I'm not as active at Lightspeed these days, but still, sit on some boards and work with the team a bit.
Thank you so much for that lovely introduction. You've clearly, of course, seen Silicon Valley transform and been in the VC space for a very long time, and we're very lucky to hear from you. Thank you again. So, you've seen Silicon Valley transform from orchards to the world's largest innovation hub. How do you think it will evolve in the next decade?
Well, that's a great question. Yeah, I have seen when I was grew up here, it was cherry orchards and apricot orchards, and been replaced by buildings in Silicon Valley and a lot of opportunity. Um, I think it'll continue along those lines. I mean, I think the Silicon Valley has always been sort of the center of innovation in the world. And while we have a lot more innovation going on globally, Silicon Valley still is one of the preeminent spots for innovation, and whether it's AI or robotics or um, climate tech or anything like that, I think we're going to see a lot of the work coming out of the universities and the teams and entrepreneurs that are in the valley.
Definitely. Wonderful answer. Switching a little bit, what's one investment or market shift that you've seen in your experience that surprised you the most?
Boy, that's a great question. One investment that surprised me the most. I can certainly talk about Snap and the fact that my daughter sourced it for
Mhm.
me, and I didn't really understand um, why people would want to use social media and for that purpose, but it obviously turned out pretty well. But I think there's also some other things in the enterprise side that um, are worth talking about. The sort of the shift. I think the shift to cloud really caught a lot of people off guard, and all the enterprise applications shifted to the cloud, and all the analytics shifted to the cloud. Um, but AI is even more. It's even faster shift and more disruptive to the incumbents. And so I don't know that there's one particular investment that outlines that. There's the LLM companies for sure that, obviously are raising a lot of capital, but there's a bunch of companies behind that, companies like Glean and others that are, enterprise applications, but they're building AI for the enterprise. And I think we're just in the early innings, first or second innings of what the enterprise is going to look like now with AI. And it's going to happen a lot faster than the whole shift to the cloud happened. So it's going to be fun to watch. I think there will be a lot of money made by investors and by entrepreneurs in this sector. And there's probably going to be a lot of money lost, by the way, too, because whenever we pile on to companies and we tend to create too many competitors in one single market, we both make money and we lose money as one thing about product market fit is it's temporary, right? And the question is, for some of these companies, because the technology innovation is happening so fast, once they get product market fit, how do they avoid being leapfrogged or becoming a Me Too product? And how do they continue to innovate? And the question is, at what cost it's going to come? Is it going to be a lot more expensive each time they want to innovate because they're going to need larger models, even with the cost of models coming down? Um, I think that I think there will be some cost component in terms of continuing to invest in these companies that are leaders in their market. Um, but invariably, there's always the creativity of the founders and the product innovation that they come up with, to continue to lead a market. And so, um, it'll be fun to watch because I think that the early leaders won't necessarily be the late winners. That we will have a bunch of companies coming out of the blue that will challenge some of the early leaders here across those markets, because the innovation is happening so fast. And what is possible from a product standpoint is changing so rapidly.
What signals do you kind of look for to determine if a startup has a real defensibility in this sort of crowded space?
I think what happens later in the later stage of an innovation cycle is you start to realize all the use cases for the technology, and then that broadens the aperture of where you can invest, across both consumer and enterprise and healthcare applications. I don't think we're there yet with AI, and it'll happen though soon. And you'll start seeing more companies that are now leaders in a new market versus yet another company competing in an existing market.
Adding on to that, like Lightspeed has backed companies across the AI stack. Do you see more opportunity in application layer companies, fine-tuning those models, or in infrastructure companies altogether that are able to enable those models?
I think the infrastructure market is has taken shape, right? It's taken shape, and we certainly have lots of bets across the infrastructure market. Companies like Mistral and Anthropic and xAI and others, and SSI, and along with a lot of our VC brethren. These things take a lot of capital, so there's a lot of investors in these things. Um, but I think when things get more interesting is when you look at the application layer, and much like when you talk about cloud and how all the enterprise software companies were disrupted by the cloud, and you had the emergence of new leaders, in those applications. And I think with AI, you have the potential for new leaders to emerge across a whole wide variety of applications. That's going to be a really interesting time, and I think it's a good time to be a venture investor in the sector, because of so much disruption happening.
Definitely. It's like kind of like a once in a century kind of moment in that sense, witnessing it as a college student, so much happening with the Gen AI space and how it's reshaping everything. Shifting gears a little bit with that sort of generative AI hype, how does Lightspeed, and you, when you make investments, ensure that your portfolio isn't necessarily overexposed to AI and still remains diversified?
Well, you always want to build a diversified portfolio, and we may have 40 to 50 companies in every fund portfolio, um, and you know you never know where the octane is going to come from. Usually, in a fund of 40 to 50 companies, maybe three to five determine the performance of that fund. And like I said, you never know where those three to five are going to come from, whether they're going to be AI companies or some other, you know, healthcare or what, fintech. They can come from all over the place. That's why you build a diversified portfolio, right? And so you want to make sure that you have enough coverage in key areas. And certainly you might even be overexposed a bit to AI because we don't yet know the full potential of that disruption, and to touch the number of markets it can touch. But you also want to be diversified away from AI in some cases, right? It could be AI use cases outside of traditional enterprise applications, but I think you want to make sure that you have a diversified portfolio. Not everything is dependent on a small number of factors because, again, you want to be in these 3 to 5 companies. That's what makes a fund perform. And there will be some losers, right? We're throwing so much capital into AI. There'll be losers. There'll be companies that, that go out of business, that leave sizable craters right in their wake.
I guess that's also what makes the VC world just that much more interesting and fun in the sense that you don't know which one will necessarily be those 3 to 5 companies and which one will fall
Yeah,
into.
and the craters are bigger too. When I started in 97, a $5 million check was a big check.
Mhm. Yeah.
Um, and
Now there
now it's a tiny check. Now a 50 million or $500 million check is a big check. Two orders of
despite adjusting
magnitude.
for inflation.
Yeah, no, it's way more than inflation.
Of course,
Because
yeah.
you got to remember too that our industry has grown from 10 to 15 billion dollars a year back in the early 2000s to 250 to 300 billion dollars a year. So, a 20x on average increase over those 20 years. Um, and so, yeah, so when you talk about writing a $5 million check and now it's $100 million check or a $500 million check, it makes a lot of sense. But it's still, I think it's outpaced inflation and the growth in the industry.
Well put, yeah. What's actually like piggybacking off of that? What's a contrarian bet that you've made at Lightspeed or in your career in general that others doubted but ultimately paid off?
Um, it's a great question. Contrarian bet. You know, we were in I didn't make the bet. It was one of my partners, but he made a bet in a company called Solar Edge, which was one of the solar inverter companies. And at the time, people just thought it was, commodity product. And turns out there were two companies doing it. Um, but the demand, and the company almost died several times when we had invested in them. Um, and then finally they got to go public. They survived. They had a great team, great CEO, and they went public and they were worth a lot of money. I think they got to be worth more than $10 billion over time. So, um, you know, clean tech was sort of poo-pooed after the mid 2000s because there were so many craters in it. But there was no sort of argument that clean energy was going to be a thing and climate was a problem. And over time, some of those companies became great companies. I mean, we're looking at some of those companies now, right? Tesla is an example of a company that sort of came out of that time, but people realized that electric cars are sort of important. But you can also make them cool and fast and sexy. So, but I think it goes to your question. It goes to the point that you never really make money in venture if you're with the herd, right? If you're following a bunch of people into a market, it's really rare when it goes well and you make a ton of money. You got to be in front of a market. You got to be early to a market. And in some cases, you might go to a market that's a contrarian market that no one else really wants to go to, um, and make bets there. I sort of look at semiconductors right now. I'm doing some work with semiconductors now, for our federal government, and semiconductors have been out of favor in VC for easily 10 years. If you go back 10 years, about 4.5% of all VC dollars went into semiconductors. And in 2022, it was 1.2%. So they've steadily gone out of favor. The problem is people now understand that semiconductors really are the platform behind most things, right? Certainly the platform behind AI, as you can see from NVIDIA's success. They're the platform behind cars. They're the platform potentially behind healthcare. They're the platform for so many things that we use day to day and so many things that are important to the economy. Um, Having said that, they're really hard. to invest in because they take so much capital and it takes so long before you know if they're going to work. Um, and so, we've shied away generally as from semiconductors, but you're starting to see people coming back as contrarians. And I think those people who are early back to the market are going to make some real money in sort of the new phase of semiconductors because everything's getting rebuilt, right? The data center is getting rebuilt. It's going to look completely different now when you use it, for AI versus, just regular compute.
Very true, especially about the entire semiconductor industry. So, actually, adding on to that, uncertain times create the best market opportunities. How do you determine whether an emerging market is worth an early bet, or is it just a passing trend?
Yeah, I mean, we say that all the time. Uncertain times, you know, um, create the best opportunities, and I believe that, and I think that's because in uncertain times, not everyone knows where to go, and people don't just follow it. Everyone doesn't follow each other, and so you have people going in a lot of different directions and placing bets in a lot of different markets, and in that kind of environment you can make money because you're first to market, like we just talked about. In a market where it's really clear and everyone knows where to go, um, you know, then you have people piling on to the same markets and it's harder to make money in those markets. So I think that we will get, you know, that's the kind of market that we all want to be in venture. In some cases, when you have really heavy innovation like AI, people think it's really clear. And maybe it's clear that you want to be in an LLM company. I don't know. A lot of people are putting money into those, including ourselves, but it may not be clear where you go next and what the use cases are. It may not be clear what the impact on robotics is. So I think it'll be an incredible impact on robotics and where do you go? And so those markets that are ripe with innovation, but it's not always clear, I think are great markets. When you're at the partner level, you can tell because when people are voting on deals, it's not always unanimous. Sometimes the deals that are the most controversial are the ones you want to make sure you're doing in your fund because not everyone sees it. And if everyone sees it, then other VC funds are seeing it, and then a lot of people are doing it. And again, you're investing with the herd. So it's just an antidote, but I find that it works.
No, definitely. It does. You've been in this industry for decades. What patterns or signals have you seen in past downturns that might indicate which startups will survive or thrive today? People always have to be kind of choosy about past downturns and analyzing them to predict today's trends and making inferences off of that. So kind of curious to hear your thoughts on what are some specific past downturns that really stick with you.
I mean, oh, you made it sound so bad. I've been around for decades. So maybe I started venture when I was 17, but I didn't. Anyway, I think I've seen almost two full cycles, and for me, a cycle is generally around 15 years. You see generally a full cycle. Um, and they're all very different, and it's hard to compare and contrast. But the things that are similar are that um, when you have a frothy market and capital is flowing very freely, then you tend to have companies with really strong growth. But over time, they have to learn how to be more efficient with their capital to be a highly valued public company. And sometimes that transition can be very hard for companies that did not have any constraints in terms of private fundraising. And in some cases, companies wait a long time and they stay private for a long time because they can raise capital anytime, anywhere as a private company. And maybe it's going to take their business model a little bit longer. to drive those efficiencies. Or maybe they want to win the market in a way that doesn't force them to have to drive the efficiencies too early. So there's a lot of reasons for staying private longer. Having said that, some of the companies that are formed, in the last downturn, if you go back to like 2005, some great companies were formed in those early 2000s. They didn't have a lot of capital to work with. They had to drive growth, but also be very efficient with it from the beginning. And so they created these really strong, enduring business models. So it's very different, as a company, which environment you sort of grow up in, but eventually you've got to prove that efficiency if you want to be a public company.
Very interesting you mentioned that, and definitely like many VCs have shifted focus towards capital efficiency and profitability over rapid growth. Do you think that this sort of like investment strategy in response to this trend is a good way to go? If you could just kind of expand more on that.
Yeah, I mean, your question really is about, growth versus profitability and the trade-offs. And and I think over time, I mean, growth usually gets rewarded more in terms of market value, but over time, growth without profitability stops getting rewarded. So it's really a matter of, in your particular market, you know, how fast do you want to grow? How important is your growth to sort of winning the market and being the number one player? And at what point do you really want to drive efficiency? Um, there's a lot of companies out there that aren't the number one in their market, that are nice companies that, that maybe they're growing 20, 30%, 40%. They're good companies, but they're not growing as fast as the leader in the market. And for them, though, driving towards profitability and being more efficient earlier is actually a good thing because it makes them a more valuable company. And they're certainly, we're not talking just a VC lens here, we're talking also a private equity lens on these companies that can be taken, we can squeeze even a little more efficiency out of them, and they can live a long life as a good company growing at a lower clip. Um, and so, it's really a matter of when these companies tend to take their foot on the gas and put a little bit of foot on the brake. And some companies do it earlier than others. But it's good that we're doing this for a larger set of companies now, and it creates a whole opportunity for VCs and private equity to invest in those companies, right? And it's sort of you get a second bite at the apple, if you will, for these companies that were once growth companies that are now, you might call them value companies.
I see. And going back, I should have asked this question earlier, but given your experience at Cisco, how do you view the future of networking specifically in the AI era? Do you think like the large incumbents are currently positioned well, or do you see a new wave of disruptors potentially emerging?
Yeah, I mean, it is changing. There's certainly incumbents. Um, there's the switching guys, there's the, Broadcom's chipsets, and they have fantastic market share. Um, but if as you go from a data center that was primarily focused around compute, uh, generalized compute, I mean Intel chipsets, to one that is more around AI compute and processing and GPUs or whatever is being created. There's a whole bunch of flavors. Um, the network changes because the traffic patterns change, the needs change. With AI, obviously you're connecting a lot of machines because they're all working together. Latency becomes super important. And so, what happens to the network? How long, what happens? Does silicon win or do optics win or a combination, right? And if you think about a network that might have a shorter useful life, then what does that mean? Does that favor optics because maybe they can sort of deal with more generational transitions in terms of speeds. But so there's a whole bunch of questions as to what happens in this new sort of network. And I think that it will be a combination of optics and switching. We'll see optics directly into chips. And we'll also see potentially more circuit switching, right? Packet switching is, has sort of ruled the day in networks forever. But as you get to a place where latency and predictability are very important in like an AI network, maybe circuit switching starts to take shape. So there's all sorts of things happening. I'm not the best person to talk about this because I'm not totally current on these trends, but I'm seeing it in the market that companies are now innovating once again for this new data center.
Got it, and thank you for sharing. Gonna kind of switch more into the VC guidance and founder relationship dynamic. You emphasize, in your view, how should founders necessarily evaluate a VC firm beyond just the capital that they bring?
Yeah, and capital is, you know, there are lots of places to get capital. I think the way that we would position our capital is we're long-term capital. We can support companies at every stage. We have funds to do that. And so some capital is early stage capital, stage, some capital is late stage capital, some capital is multi-stage capital. And that's sort of how we think about it, is supporting a company from, start to IPO and potentially beyond. Um, but we got to bring much more than money, or else AI should just replace VCs. But what do we bring? There's a sort of set of services that VCs have, you know, started to deliver. Most of those are around things like customer introductions and hiring and, helping you get your financing done. And that's all great, but those are generally table stakes. I think, um, as from an entrepreneur standpoint, you want to not only get to know the firm that you're going to work with, but you want to get to know the partner or partners that you're going to work with and understand what they're all about and talk to CEOs that have worked with them. What happens when times get tough? What happens when times are good? When you have key decisions, or how helpful are they? What kind of perspectives do they bring? Do you have good chemistry with them? And those are all things that I think you have to evaluate, because you're going to have some of these early stage investors around your board table for 8 or 10 years. That's a long time, right? You might as well make sure they're a very good fit and they're going to be, super helpful in helping you build your business up.
Absolutely. And kind of going back into delving deeper into founders, founders often struggle to balance vision with execution. So when you provide guidance, or in general, when you're looking for different startups to invest in, what qualities do you think make a founder, well, truly exceptional in your experience, for one, and also one that would um, also follow the valuable advice and guidance you would have to offer?
Well, I think the best founders don't need our advice. And that's also a tricky one, because as a VC, especially as a young VC, you want to come in and be helpful. And sometimes you self-select into founders you think need your help. But the best outcomes I've seen are founders that really don't need your help, or only need a certain amount of leverage from you. Um, Founders are an interesting animal. They're amazing. We need more of them in the world. But the best ones, have this just different set of characteristics that are sometimes hard to identify at the beginning. But as they go through the challenges of building a company, the ups and downs, especially the downs and the hurdles, you watch them get through those things, um, you know, with grace and with speed and with persistence and teamwork and all the things, and creativity and innovation. Um, and So it's really hard to say, gee, this person's going to be a great founder if they've never done it before, until you see them go through it. But it's all those things that um, that help you get through with a team the hard parts and help you take advantage of the opportunities that make great founders. Right? They never do it alone. They always do it with great teams. They usually leave their ego at the door. They're good communicators. They want to go win. They have charisma. They don't take no for answers. I mean, it's all those things. And you could ask 100 VCs and probably get 95 different answers. But they're different animals, and we need more of them. And God bless them, man. They're the ones who make VCs look good.
Absolutely. I mean, kind of looking at those same qualities and different ones, how do you decide to hire a new partner at Lightspeed? Or what are the kind of main sort of qualities you look for in hiring other VCs or partnering or co-investing with other VCs?
That's funny because it's the same thing. It's like, when we look to hire VCs, where do people think we normally go? We go look at product or engineering roles at startups, MBAs, corp dev, you know, people in corp dev who are doing acquisitions for strategic acquirers, sometimes other VC firms, and and you have to sort of decide whether how much of the going after other VC firms versus, straight out of, you know, building your own. It's like a sports team that's, building a NFL team that's building through free agency is from other teams. And then for the draft is really how you build a great team. I do think that through the draft and hiring people out of industry and school and onboarding them and helping them become good investors is the best way to build a great firm. But you can also supplement that with some free agents. In terms of what we look for, there's always they have sector expertise. Can they identify markets and size markets? They have good calibration on people? Do they understand products and competitive landscapes, all that kind of stuff? That's all great. I think it's table stakes. And my experience is a set of intangibles that really matter when it comes to people either succeeding or not succeeding in venture. And when I talk to people, I say, judge yourself. Give me a score for yourself on these intangibles. But I'll just list them. It's hustle, persistence, selling skills, likability, EQ, team orientation, resourcefulness, drive, work ethic, seeing the big picture, competitiveness, and self-starter. And there's more for sure, but those 12 are really important. And you ask, well, why? Well, self-starter. Why is self-starter important? Because VCs are terrible managers. And we're not going to tell you, as an associate, what to do every day. You got to figure out what to do every day. You got to be a self-starter. You can't wait for someone to give you direction. Persistence. Why persistence important? Because you hear no all the time. You got to be persistent to get the attention of CEOs if you want to see a deal, right? Why is hustle? Because you got to hustle to get in front of the crowd, right? And so it's all those things that really matter. And when I talk to potential candidates, I use that lens.
Wonderful. Like, thank you for sharing. I think that's so important for people like me who are interested in getting into the VC space to know what exactly is the criteria or just like what do you kind of define as a good VC. As a budding VC myself, who's very early in my career, what would be your top advice to people like me and people in this generation who want to enter the space of venture capital?
I think it's funny because if you go back 30 years, and I do almost in venture, all venture capitalists, firms look the same, and all the venture capitalists look the same. We all did early stage enterprise with a little bit of consumer, but we're all the same product. And now that the industry is 20 times bigger, we have all sorts of different products. We have early stage VCs, late stage VCs, we have sector specific VCs, and so I think an important thing for you to do before you go into VC is really figure out what are you, and what are your strengths and what do you like doing, and are you an early stage VC or a late stage VC? There's very big differences, right? With as an early stage VC, you need to build things, right? And you sort of have to understand the, you know, uh, you have to understand the technology and you got to be able to anticipate markets. As a late stage VC, you got to be good with numbers and metrics and trends, right? But they're very different jobs. So the first thing you have to do is you have to figure out, am I an early stage VC and or late stage VC? Then you have to decide whether, you're a sector focus or not. Is there a particular sector? There's not as many generalists anymore in VC. We used to all be generalists. Now there's hardly any left. And so, think of yourself as a product. And how do you describe yourself as a product to a VC firm? And then you got to go find the right firms that where you have product market fit. And so that's my best advice is make sure that you're not doing that on the fly. You're actually doing it before you go talk to VC firms so they know how to think about you. And they'll know, really quickly whether they have a need for someone, who is what you are in terms of your product.
That's wonderful advice, and I'll make sure to follow through on that and let everyone else know as well who's interested in the VC space. Thank you so much again, Barry, for your time. And I'm sure my viewers and I are incredibly, incredibly grateful to have had the opportunity to speak with you and get such, great gems of wisdom to share with everyone.
Well, it's always a pleasure, Taarini, and good luck to you on your journey. We definitely need more young VCs in this world, and we also need young entrepreneurs too. So hopefully, people that are listening to this will go in one of those two directions. Thanks for your time.
Absolutely. Thank you so much.